All right, this week's episode of the I-501CU, the podcast for nonprofit board members, I interview William Kennedy. Bill Kennedy. Bill is the co-founder, CEO, and chief investment officer of RiskBridge Advisors. He does a lot of work in our area. He lives up in the Northeast, extensive investment advisory, investment management experience. And he goes into what a nonprofit board needs to understand about investments. So please join me as I interview Bill Kennedy. Hey, everybody, this is Michael Corley. Just wanted to let you know we are now sending out a weekly, very brief newsletter. Tips, tricks, pointers to nonprofit executives. That includes both board members and CEOs, executive directors. If you're interested in receiving this, please go to thecorleycompany.com/newsletter and you can sign up. Once again, that's thecorleycompany.com/newsletter. Well, I'm excited today to interview Bill Kennedy. Bill is Chief Executive Officer and Chief Investment Officer for RiskBridge Advisors. We actually got introduced by my first podcast guest, Susie Bowie, suggested that we connect. And so, Bill, welcome to the I-501CU, the podcast for nonprofit board members. Please share with the audience a little bit about yourself and how you got into this crazy business.
Well, thank you, Michael. It's a pleasure to be here and really excited to be talking about nonprofits and how investments should be working for nonprofits. So it was not a direct route to RiskBridge, I can tell you that much. I started my career back in the early 1990s at the DuPont Pension Fund. Based in Wilmington, Delaware. I was an asset allocation analyst to begin with. Then I became a specialist investing in the Japanese equity market. And the only thing you need to know about that was when I started investing in Japan, the Nikkei was at 28,000. And when I left, it was 8,200. And it wasn't because of me, but I have a lot of scar tissue from that decade or so of experience. DuPont was a great training ground, got my CFA there, but that opened up an opportunity for me to go to Wall Street. And I joined Sullivan Brothers back in 1996 in their Japanese business, and wound up having the opportunity to work and live in Japan with Sullivan Brothers in the late 90s. That went through a couple of mergers. It became Citigroup while I was there. And then I came back and ran all of the capital markets research for Citigroup for several years, from 2003 through 2008. And I think all that background and experience is important because it's steeped in asset allocation theory, which we use today. It's steeped in a global view of the investment world, which we use today. And as a research professional, one thing that we really emphasize at RiskBridge today is our manager and market research capability, trying to help our clients, including our nonprofit endowment and foundations, think their way through risk. I left right before the financial crisis, left Citigroup. That was pure luck, not by design necessarily. And wound up in the insurance field, working with the Marsh McLennan companies, giving strategic advice to insurance companies about their assets. And I like to say everything I learned about risk, I learned through that role, because the business of insurance is all about pricing risk and mitigating risk. And came back into the investment field, worked at a private bank as a chief investment officer. This was at Field Point Private, which was based in Greenwich. We had about $4.5 billion of client assets at the time, mostly ultra high net worth individuals, some institutions, and really wanted to get back into a focus on institutions. And that was the catalyst for forming RiskBridge. We started this company right in the heart of the pandemic in July of 2020. But the whole notion behind RiskBridge was trying to take that 30 plus years of experience, thinking about risk, thinking about the complexities of the markets, doing a lot of work with endowments and foundations and nonprofits along the way, and bringing all of that together to try to give a better solution set for those institutions that are doing such great work for their clients, right? Whether it's trying to provide community services or do some healthcare research, educate another kid, or even have a good retirement, right? We think that's a worthy cause, and we're excited to be working at RiskBridge to try to advance that cause for our client.
Oh, Bill, I think that's great. I appreciate that. I'm sure you have so many stories. Hopefully you were shorting that yen, the Nikkei market all that time. Well, I guess had you been, we wouldn't be talking today. You wouldn't have to work. So we appreciate the learning lesson. So let me ask you. So I'm always curious by this. RiskBridge Advisors is a fiduciary. What does that mean, and why is that important to us in the nonprofit space?
In this most simplistic terms, a fiduciary always puts the client's interest first. It's not about a commission. We don't accept commissions. It's not about are you maximizing your fee? It's not about trying to find other ways to generate revenue. All that is secondary or tertiary. The primary focus of the fiduciary is doing the right thing for the client this time and every time. And so what we, having come through Wall Street and see how that industry creates product that's really quite good for the product manufacturer, but it's pretty lousy for the investor, and especially the nonprofit space, we just felt that serving as a fiduciary, being on the same side of the table as our clients, and always putting our client interests first and foremost that was important to us as individuals and as business partners, and that's what being a fiduciary means. And so it's just always putting the client interest first.
And is there something you have to go through to be designated a fiduciary?
We have no fiduciary certificates hanging on our wall. But it's really the principles of your business, the way that you contractually engage with your clients, always ensuring that their interests are coming first and foremost. For us, one of the things that I'm a CFA, a chartered financial analyst. That's no guarantee that you're going to be a fiduciary, but there's a lot of training and continuing education that comes along with that. That helps us to stay in front of what's required to serve as a fiduciary.
Yeah, and I asked that question on purpose, and to the board members listening, you learn the tenor, you learn the culture of these investment advisors by asking them questions just such as this. And anybody can go to your website, Bill, and see that you really do take the fiduciary obligation quite responsibly. And I just encourage people, ask that question. There may be groups that say they are, but you ask a few questions, you'll figure out pretty quickly that they really aren't.
Michael, you're absolutely right. And the key is where's your revenue coming from, right? What's the source of your top line revenue for your advisory business? Is it coming from commissions? Is it coming from selling other products? There are some firms that will treat their manager research as a profit center, right? They'll take marketing dollars to have a manager on their platform. Not illegal. In fact, it's sanctioned, right? It's okay according to the Securities and Exchange Commission, but is it ethical? And is that in your client's best interest? So I've always said the best thing a board can do in their due diligence process is explain to us the top 3 sources of revenue. And that revenue should be, for any fiduciary, it's only the fee for the advice that fiduciary is providing to that endowment or foundation.
Oh, very good advice. Thank you, Bill, for that. That is worth its weight to any board member. So let me ask you this. On the website, and I'm looking over here, you say when enterprise risk informs their portfolio risk. Well, help us understand a little bit the concept of risk, enterprise risk. As board members, how do we digest that, and how should we look at risk?
Yeah, so this is probably where that experience in the insurance industry starts to show itself. So enterprise risk management, the acronym for that is ERM. That's an actual study, and it's looking at risk holistically. So anytime you hear enterprise risk, you're just thinking holistic risk. For a nonprofit, what can generate enterprise risk? Think about what are all the sources of revenue for you as a nonprofit. Where's your revenue coming from? Are you writing grants? Are you taking funds from the state or federal government? Are you purely focused on donations from the private sector? Sources of risk to your revenue is one element of enterprise risk that we try to help our boards think their way through, away from and aside from what's happening on the investment side. A second is, what about your cost base, right? What are you spending on staff? Are you finding facilities and technology and compliance and everything that's related to the expense of the nonprofit? That's part of enterprise or holistic risk. And the third one is really operational risk. Are you subject to cybersecurity threats as an organization? What do you do when a global pandemic hits and your ability to serve your clients goes down, but the demand for your services goes through the roof? And we've seen that repeatedly with a number of nonprofits, as I'm sure you have as well, Michael. There's no better example of enterprise risk and its impact on a nonprofit than what happened in 2020 and 2021. Small liberal arts colleges, 80% of their freshman class didn't show up, right? So that has all this interdependency to the revenue side and the expense side and the programming side or academic side of that institution. And therefore, what's it mean for your endowment? How should you think about the investment of those assets in preparation to protect the organization through that sort of environment? So that's all we mean by enterprise risk. It's thinking about risk holistically. And our little firm, RiskBridge, that name was created to try to find a way to bridge that gap that exists between enterprise risk and investment risk.
So depending on the enterprise risk that you identify, you work with your clients on, that will dictate, prescribe, adjust how you invest their assets?
Yeah, it could. So for instance, if your endowment assets are established for perpetuity and you're investing for very, very long term, and you're just trying to meet that 4% payout or the 5% payout, whatever the case might be. If you suddenly have a gap or a hole in your budget because of some risk event taking place, how should you adjust the endowment to try to help fund that gap or bridge that gap, if you will? That's one. The other is thinking about your endowment's structure, right? You can have full endowment accounts, but maybe you've got a quasi endowment account where the funds can be they can be invested for the long term, but they're not necessarily funds earmarked for perpetuity, right? They may be for a more specific purpose. And then we do a lot of work with boards, helping them think through that liquidity reserve account. Liquidity reserve accounts didn't really matter the last 15 years because interest rates were zero. So it was just cash, right? Didn't make any money. Well, lo and behold, here we are 15 months into a Fed rate hike cycle, and you can make 5 and 5.25% today on cash. And so liquidity reserve accounts become a little bit more important. But thinking of how to use that as a rainy day fund, that comes into the conversation about trying to think through all of those what ifs coming down the road. And so not only is it changing the way the endowment might be invested when bad things happen, but how do you prepare for that in advance and maybe think about the structure of your funds, having a long-term perpetuity endowment fund, a medium intermediate fund to help cover some of your operating expenses, and then that liquidity reserve fund to really meet some of the ongoing operations of the organization.
So quite a bit to think about. And I'm guessing in a perfect world, a board would call you early in the process. They probably don't, because I know how we operate as board members. So when does a board call Bill Kennedy? What educate us a little bit. When should people reach out to you?
Well, it's interesting. Our experience has been, and this goes back to before I started RiskBridge, right? Even at the prior shop, but certainly since we've started RiskBridge, we get called in under three scenarios. I'll give you three case studies. Maybe that's a way to approach it. So the first case study, we've had some experiences where institutions have been around for a few decades, but relatively small. And suddenly, for whatever reason, they've received a bequest, or there's been a large influx of capital for the endowment. And that board is looking to go from making the decisions with their purely index funds that somebody on the board is probably helping pull the trigger and put them together, to trying to institutionalize the investment process, right? So it's going from a small endowment to a larger endowment, but one that is going to require a little bit more governance, a little bit more belts and suspenders, and the policies and procedures and everything that comes together for that. So that's one example. Secondly, we have a number of opportunities where it's a sizable endowment already, but they just haven't been, they've sort of been underlooked and overserved by either their existing advisor or the OCIO community in general. And it may be because they are not $100 million endowment, right? It's something well south of that. It's not that large, but the complexity is just the same, whether you're a $10 million endowment or $100 million or $1 billion endowment. And so we'll be brought in to try to professionalize and, again, institutionalize some of their process. The last one would be organizations that have a lot of logistical complexity to what they do. This could be healthcare foundations, could be organizations dealing with food insecurity, or trying to provide lots of services that are high frequency type services. And I'm thinking of food banks and feeding the underprivileged, right? That is 3 meals a day, 7 days a week. And there's a lot of moving pieces in that where it's ripe for enterprise risk. It's ripe for holistic risk that could impact the organization. Could be through their vendor relationships, could be in their technology structure, could be in how are they going to fund additional services if they're trying to build out. And so we'll get called in to help them think through risk holistically. And sometimes we'll do that on a consulting basis. We're not doing the investment piece. We're just kind of focused on the risk piece. And then the fourth example I'll give you is we work a lot with really, really good executive directors and staff of nonprofits that are just looking for an outside entity to come in to help board governance, partly around investments, but also what's it mean to be a good board member. And so we have a series where we'll come in and just work with that board to think through how do you recruit new board members and try to increase the engagement that those members have in that organization. And I know you do very similar work, and you've had a really strong impact in the region there. And I think that's where we are able to again think about how to improve the board's delivery, not only of their fiduciary responsibility, but just make them a stronger board and try to enhance the impact that they're having towards their mission, if that makes sense.
It certainly does. That's music to my ears because there isn't enough good governance, and I don't mean that in a derogatory way. It's just we've joked in previous podcasts that you really can't create a more dysfunctional system than the nonprofit, how it's set up, right? You've got a CEO, then you got this board that rotates, it's unpaid, and they come and they go, and the officers change every year, and there's no continuity, but you're expected to have this level of governance, that's stellar. It's quite complex and challenging. So I'm glad y'all offer that service.
Yeah, Michael, actually, if not to turn the table here on the conversation, question for you is, are you seeing a lot of board churn, meaning membership retirement, kind of post the pandemic era, because there was just so much stress on these organizations? And I'm just curious if it's something we've dealt with and we're trying to address, but if you could just maybe educate me a little bit on what you've seen in terms of board turnover.
Yeah, I think that's a fair question and statement. I've received more requests recently to talk about recruiting, engaging prospective board members than I have in quite some time. So I think that's a fair statement that there's some churn going on and people really reconsidering whether or not they want to contribute their time in that fashion. So we've got some work to do.
Yep.
Absolutely.
And from an investment standpoint, every time that turnover happens, it's an opportunity to educate, right? So it's an opportunity to bring them up to speed, and having that strong investment governance in place at the institutional level, so that there's some consistency as you go from generation to generation of board member. I think that's very important.
Yeah, I think that's a very important statement. I'm glad there are organizations like yourself that can provide that continuity. That is really important. And related to that, Bill, what is the board's role, or should be the board's role in investment management? I use that term broadly. I'm not defining it, but what should the board's role be?
Well, we've always thought the primary responsibility of the board is to ensure that the investment assets are structured to deliver on the long-term mission of the organization. So that's making sure that the risk and return are aligned. And we spend a lot of time working with the board. We assess their risk tolerance as individuals. We do surveys and we assess their risk tolerance as individuals, and then their risk tolerance as a group, as a team. And then that helps to inform how much risk and what types of risk is suitable for that organization's endowment, because it's matching it not only with the board's risk tolerance, but tying it back to the long-term nature and the perpetuity, assets being invested into perpetuity. And but at the end of the day, the board's primary role and responsibility, as we see it, this is my opinion, every board is different, but my opinion is it's to ensure that the assets are managed consistent with the mission of the organization to allow them to achieve their purpose.
And so is this where the investment policy statement starts to take a meaning as an important? And could you talk a little bit about the IPS, its role, its importance, and how you approach it?
Absolutely. So we do not think the IPS is a tick the box exercise. We view it as the heart of the investment process. So what is the IPS? It sets forth both the policies and the procedures of how the investment assets, the endowment assets, should be managed, the roles and the responsibilities of the board, of the finance committee or the investment committee, and of the investment manager, if there is one, and really trying to make sure everyone's very clear on what their purpose is. Then it really creates that framework to help identify what's the long-term return objective, the realistic long-term return objective to achieve the organization's mission. That gets laid out in the IPS. It's a form or a document that helps set the bar, the standard for how the board or the finance or investment committee are going to measure and monitor the performance of the investment manager, like RiskBridge, right? So that should be the very clear articulation of this is how we're going to define success in the investment program. Probably most important, Michael, it's a great communication vehicle, right? How does the board and the finance investment committee interact with one another? Who's responsible for calling the investment manager? Who does the investment manager go back to, right, at the investment committee? So all that is to say that investment policy is a living document, and it's really designed to help ensure smooth communication and implementation of the endowment investment program.
And this document is approved typically by the investment and or finance committee, I guess investment committee, and then the full board, or how does that work?
We've always suggested best practice is the finance or investment committee should sign off on it, but take it to the board for full approval. And the reason for that, ultimately, look, we're a fiduciary, and part of what we get paid to do is lift the fiduciary burden off the board, but we never take the fiduciary burden away from the board. The board is always still responsible and still has that fiduciary duty. We're just being hired to make it a little bit easier on them. And so part of that duty is ensuring the policies and procedures are in place. And that's why we always recommend that the board ratify that investment policy document before it gets put into use.
Well, I'm glad you said that the board never can abdicate its fiduciary responsibility. You help them honor that through this document. And that we've done a few podcasts on board members who say, I don't know anything about investments. I don't know anything about finance. Usually it's the financial and the accounting side of things, but even investments, I don't know. When you hear that, because I know you do, because I know that's why we were introduced. When you hear that, what do you say? How do you walk board members along the path to understanding, or at least getting a little bit comfortable with the process?
Yeah, it's all about education, and it's number one, and I'm guilty of this. It's getting rid of the jargon, right? Many times I don't understand it is shorthand for I have no idea what he or she just said. So I'm just gonna tune it out. So part of it is education by getting rid of the jargon and just covering the very basics. Mm-hmm. Your question, what is a fiduciary? Making sure that's clearly understood by each board member. Number two, what does diversification mean? Right? It's this idea of you want a little bit of stocks, you want a little bit of bonds, and the idea is sometimes stocks are going to go up and bonds are going to go down and vice versa, but you're always going to have some diversification in that portfolio, which is prudent, right? It's a best practice to have in place. And then I think secondly is thinking through what is asset allocation? How do you translate that into risk allocation, right? What does risk mean for an organization like that? So it's just trying to boil down some of those basics of endowment management and asset allocation and investment management. One of the things that we preach, and we think the academic research supports this statement, but we are of the belief that 80% of an endowment success is just getting the policy and the asset allocation right. 20% is some combination of the managers you select, the securities you select, the fees that you pay. They all matter, but they don't matter as much as getting that risk aligned right up front. And so we spend a lot of our time in the education process with the board, really not focusing on the manager selection, because long-term, that success is just being in the right asset class through the asset allocation and the risk allocation process. So that's an important element of getting the board to achieving their fiduciary role.
That last statement is very, very interesting. So when you look at boards you're talking to, what mistakes do they make? If that's a fair question, or where do you see them maybe not taking full advantage of an opportunity, just when you walk in and start speaking with them?
Oh boy, great question. Actually, I have to tell you the behavioral science behind a board is one of the most fascinating things. It's a microcosm of the market, right? The market's made up of millions of participants investing in millions of different securities, but at the end of the day, the market's always right. It's the weighing mechanism that is going to tell you. And that exists on the board, right? There are some board members that are, I don't understand investments, I'm not going to get involved, to your previous question. And there's some board members that are masters of the universe when it comes to investing. They've got all the answers. When you put those boards together, if they're well-constructed boards, you get this diversity of view and thought and concept. And so we find most of the time the boards are doing okay. But I will answer your question. Probably the single biggest mistake we see from board members are selling at the bottom and wanting to buy at the top. Just human nature. Fear and greed many times outweigh everything else. And so part of our duty in protecting their fiduciary responsibility is helping understand why drawdown management, right? Things are going to work against you over time. That's not the time to panic, right? And so we always talk about prepare, protect, perform. That's kind of our punchline at RiskBridge. It's helping them prepare that there's a drawdown coming. Don't know when it's going to happen. Don't know what's going to cause it. All we want to do is not fall as much as the market so that we can get back to break even. And by all means, don't sell right at the bottom, because then you're destroying value. You're going against the mission of the organization. That's number one. My favorite is, I got a guy. Hey, Bill, I got a guy. He runs this really cool hedge fund. I'd like you to take a look at it. And we're an outsourced CIO. So our job and what we specialize is going out and finding what we think are best of class managers to actually manage the equities and manage the fixed income. If the endowment's large enough, we get them involved in our alternative funds that we select. But sometimes we see a board get a little bit too active in the manager selection process. And we can understand why, but I go back to that 80-20 rule. If the manager selection is only accounting for 20% of your success, I'd rather be having the academic debate, analytical debate about why asset allocation is what it is, as opposed to, pick this manager. So we see that frequently. And I think the other is on a governance issue or governance perspective, a lot of times we don't see investment committee charters, right? That's just a simple document that says, what's the role of the investment committee? That's an important element that we think we like to see. The investment policy statement usually is missing two important pieces. There's not a philosophy. What's our investment philosophy as an organization? And that could be very simple, like we want to optimize returns with the least amount of risk, or if the organization has some considerations that we don't want to invest in certain things, that should show up in the philosophy. But we rarely see a philosophy in an investment policy statement. And the thing we never see, and this is part of the reason we started this organization, we never see a crystal clear definition of risk. We always see we want to be prudent about risk, some squishy language about risk. We believe the long-term returns for any endowment is a function of how much risk you take. And therefore, every investment policy that we create for any of our clients has a very specific volatility or risk target. And we get managed to that target. And it's this whole notion of risk gets treated like a byproduct. And I think that's a mistake for all investors, not just endowments and foundations. We see it with our insurance clients. We see it with our private wealth clients. risk is not a byproduct. Risk is what you are trying to solve for. You optimize it, you embrace it, because it's that risk that you're taking that's going to generate the return. And so we just kind of take that whole philosophy and flip it on its head.
Oh gosh, Bill, it's so much there that we don't have time to get into, but I really like that wording that you just shared about risk. Let me ask you this as we're winding down. Last question: is there anything else that we haven't covered that you want nonprofit board members to be aware of in your space?
Yeah, I think, look, we're coming through a very unique, unprecedented period of about 15 years where money has been free. This is a comment about monetary policy. It all goes back to the global financial crisis, right, in 2008 and 2009, and then how to prevent the global economy and certainly the U.S. economy from falling off. And I raise this topic because it's very important that now that money is no longer free, now that the federal funds rate is 5.25%, it's really going to differentiate between the winners and the losers in the capital markets. A lot of mistakes get covered up when money is free. And so whether it's a manager or even an ETF where the role of indexation exists, the move towards index strategies for investing exists because there was free money. I think it's going to be very interesting in the next 5 to 10 years where selection of, not in every category, but selection of good active managers who do a good job of good risk management, and they give you excess return because they have the ability to avoid the losers and allocate and select the winners. I think that's going to be an important factor to consider, because we've run into a lot of boards who've said, you know what, I'm just going to index it. It's cheap, it's easy, I'm going to follow the market. And I think that methodology was really a good idea in the last 15 years. I don't know about the next 15 years. It's something that we're doing research on, and we're helping boards think their way through whether they should do more active management in their endowments.
Oh boy, that's a whole discussion that can go on all day, couldn't it? Active versus passive management. I'm glad you teased everybody, which makes my next question even the most important, perhaps, of all this. How do people find out more about you, Bill, and RiskBridge Advisors? Where do they go to learn more?
Absolutely. So probably the best way, you can find us at our website. That's www.riskbridgeadvisors.com. If you have an interest, we publish a regular newsletter, market newsletter, talking about capital markets. Sometimes we talk about board and fiduciary issues, but you can sign up for that either on the website or just email us at info@riskbridgeadvisors.com. We'll get you on that distribution list. That's a free service. We just like to share that with our network and love to see that network grow. So those are the two easiest ways.
Bill Kennedy, the CEO and Chief Investment Officer at RiskBridge Advisors. I can't thank you enough for coming on today and sharing wisdom. And I know the board members are better off because of it. So, Bill, thank you very much.
Thank you, Michael. Good to be with you.
Oh, what a great discussion with Bill Kennedy. Now, this segment, recapping with Reed. Reed, you listened to the conversation. What 3 things stuck out for you?
So the first thing that stuck out to me was when discussing the board's role in investment management. And the board's role is to ensure the invested assets are structured to deliver on the long-term mission of the organization.
Oh, that's good. It forces the board to think long-term, and that's really what the investments ought to do. That's a really good point, Reed. What do you have for number 2?
When we were discussing the investment policy statement, Bill said that it sets the policy and procedure of how the investment assets should be managed. It's a document that helps set the bar with how the board is going to measure and monitor the performance of the investment manager.
Yeah, it really is. It's almost a bylaw. It's like the bylaws, but in this case, it's for the investment committee and the investments of the organization. And number 3.
Based on research that they have conducted, about 80% of an endowment's success is getting the policy and asset allocation correct, and nothing and 20% of it is about the actual investment manager's performance.
Oh boy, and that is one provocative statement, but I'm sure Bill can back it with some data. That is really, really important for all you board members out there that sit on the investment committee, that really getting all of that in place, and it's less about the manager that you have. Very, very interesting. So there you have it, ladies and gentlemen, recapping with Reed on this episode of the I-501CU, the podcast for nonprofit board members. We'll see you next week.